how investors use sector rotation to spot the next market leader. Sector rotation is one of the most useful ways to understand what markets are really doing beneath the surface. Because even when the main stock index looks stable or even rising, the leadership inside the market can be shifting dramatically. And that shift often tells you what investors believe is coming next. A useful way to think about sector rotation is this. Markets are constantly trying to answer one question: what is the next phase of the cycle? Different sectors tend to lead at different points in that cycle. For example, when investors believe interest rates are about to fall, growth sectors like technology often start to outperform. That's because lower yields make future earnings more valuable, and tech companies are priced heavily on long-term growth expectations. On the other hand, when investors think inflation is sticky or rates will stay higher for longer, leadership often shifts towards value sectors like financials, energy, or materials. Financials can benefit from higher interest rates. Energy and materials often perform better when inflation expectations rise or when commodity prices strengthen. So the first thing investors watch is relative performance, not whether the market is up or down, but which sectors are outperforming the broader index. Because when sector leadership changes, it can be an early signal that expectations are shifting. The second thing investors watch is breadth. In other words, is the rally being driven by just a handful of stocks, or is it spreading across the market? If the index is rising, but most sectors are flat, that's often a sign of fragility. But if multiple sectors are participating, it suggests stronger conviction and broader risk appetite. The third thing investors watch is defensives versus cyclicals. If utilities, healthcare, and consumer staples start to outperform, while cyclical sectors lose momentum, it often signals that investors are becoming more risk-averse. And this can happen even while the main index still looks healthy. Finally, investors watch rotation within rotation. For example, within the technology sector, leadership might shift from high-growth software names to more stable semiconductor companies. Or within consumer stocks, it might shift from luxury brands to discount retailers. That internal movement can be one of the earliest signals of changing market conditions. The key takeaway is this: sector rotation is less about prediction and more about confirmation. It helps investors identify where money is moving, what themes are gaining traction, and whether the market story is changing. And if you're paying attention, you can often see that shift long before it shows up in the headlines.